Good morning, students. Our today's topic in business studies subject O levels is pricing strategy. So, the first thing in the lecture is reasons for adopting pricing strategies. So, why businesses, why companies adopt different kinds of the pricing strategies? This is the first topic. A business can adopt pricing strategies for several reasons, and these are the reasons. Number one, to try to break into a new market. Number two, to try to increase its market share. Number three, to try to increase its profits. And number four, to make sure all its costs are covered and a particular profit is earned. So here are some pricing strategies which different businesses adopt. Number one is cost plus pricing. Cost plus pricing is the cost of manufacturing the product plus a profit markup. So in this business, in this kind of the pricing strategy, a business set the price in such a way that cost should be covered, and above that maybe 20% or 30% profit is added. So this is called cost plus strategy. Advantages of this kind of cost plus pricing is fair method. It is a fair method of price fixation. The business executives are convinced that the price fixed will cover the cost. Definitely price will be covered the cost. So this is the first advantage. Number two, assured profit. If price is greater than cost, the risk is covered. So definitely above that cost of the product, 10% or 20% or 30% is added. So it means profit is also assured. Disadvantages: ignores demand. It ignores the demand. It fails to take into account the buyer's needs and willingness to pay, which govern the sales volume obtainable at each series of the prices. So the first disadvantage of this kind of price strategy is the business does not consider what customers are willing to pay. They ignores all this and set the price by their own by adding a profit into the cost. That is called cost plus pricing. So this is the first disadvantage. Second is ignores competition. It fails to reflect competition adequately. So this is the second drawback of this kind of strategy. So what the other businesses are charging, they ignore it. They set their price. They set the price of the products by their own. Okay, an example of this kind of this strategy is if the total cost of making 2000 chocolate bars is $2,000 and you want to make a 50% profit on each bar, what would be the sale price? So look now, cost price of a bar will be, because 2000 chocolates and $2,000 are the cost price. So 2000 by 2000, so $1 will be the cost price of one bar. Profit is 50%. The business want to charge 50% profit, so 50% of one will be $0.50. So it means sale price will be cost price plus profit. So 1 plus 0.50 will be 1.50 will be the sale price that the business want to set if this kind of the data and this kind of the strategy is followed. The next is penetration pricing. Penetration pricing is when the price is set lower than the competitor's price in order to be able to enter a new market. Advantages of this kind of the strategy is this allows companies to quickly capture a significant share of the market because you are offering a price lower than your competitors. So you will be able to capture a significant share of the market very quickly. Number two, build brand loyalty. As noted, the goal of the penetration pricing is to attract new loyal customers by offering a competitive price. So definitely customers are getting lower price, so they will come to you rather than to your competitors. So definitely they will be loyal to you. So this is the second advantage. Number three, lower prices result in higher sales volume and an increased inventory turnover. turnover rates. So definitely sales will be greater as compared to your competitors because you are offering lesser price, and inventory turnover will be high. So this is also advantage. This approach is often used in the launch of such products like consumer products. So like consumer products, this kind of this strategy can be adopted. But the disadvantages of this kind of strategy is the product is sold at a low price and therefore the sales revenue may be low. Definitely price is low. So in total, the revenue will also be low. Number two, this strategy can lead to price war in which all the competitors lower their prices. So there is a fear that if you are selling the products at lower prices and the competitors are seeing that their customers are going to you, so it is fear that a price war will be started, that competitors will also lower their prices. So on the whole, there will be lower price in the market of a particular product and all the businesses will suffer a loss. So this is the disadvantage. Next is price skimming, creaming. Price skimming is where a high price is set for innovative products when they are first introduced onto the market. A high price is charged and the product is often seen as luxury. This is the case of the newly coming mobiles into the market. For example, Nokia, when launched a new version of the mobile, actually that version is having a unique features, so the price will be high and the customers are willing to pay the high price because that is a sign of the luxury when you purchase the mobile. So advantages of this kind of strategy is price skimming helps the company in recovering the research and development cost which are associated with the development of the new product. So definitely when you will charge high, you will be able to cover your research and development costs. This is the first advantage. Number two, if the company caters to consumers who are quality conscious rather than price conscious, then this type of the strategy can work in greater way for a company. So this kind of the strategy will work better on the customers who are quality conscious rather than the price conscious. But the disadvantages of this kind of the strategy is this strategy can backfire if there are close competitors and they also introduce same products at lower price. Then consumers will think that the company always sells the products at higher prices, which will result in consumers abandoning other products of the company also. So the disadvantage of the this kind of the strategy is if your product is not unique and the other companies are selling close to products as yours at lower prices, then the customers will go to that business, abandoning your business. Brand loyalty will be loose as far as you are concerned. So this is the first disadvantage because the customers will think you are charging high because almost same products are available from the other business at the lower prices. So this is the disadvantage. Second is price skimming is not viable option when there are strict legal and government regulations regarding consumer rights. So this is another disadvantage in a case when government has set the price. For example, in case of some utilities, government has set the price, for example, per kg price is this one, so you cannot charge high. So this is the disadvantage. Number three, it may put off some potential customers because of the high price. So this is the third disadvantage. Note, this strategy is often used to target early adopters of a product service. These early adopters are relatively less price sensitive because either their need for the product is more than the others or they understand the value of the product better than the others. So this is very important point. This kind of this strategy will be applied to those customers who think, who understand the importance of your product as compared to the other customers. And number two, if your quality is good, the customers who are quality conscious rather than the price conscious will be attracted to you. So this is the point. Next kind of the price strategy is competitors-based pricing. Competitor-based pricing chooses a price very similar to that of the business competitors. This is used for similar products. So if in the market products are similar and your competitors are also selling those products, so you will be forced to sell the product on the same price as of your competitors. So this kind of the pricing is called competitors based pricing. Advantage is sales are likely to be high as your price is at a realistic level and the product is not under or overpriced. But the disadvantage is, the main disadvantage is that the business needs some other way to attract customers. It has to use non-price methods to compete, for example, providing distinct customer service or better availability. So if the product is available throughout the market at the same price and the product is there in a bulk amount, so to attract the customer you have to adopt some other kind of the strategies, for example giving them gifts, for example nice service. So these kind of the extra things you have to adopt when you are doing work in a market in which similar products are available. Next disadvantage is, in order to decide what this price should be, you would have to research what price your competitors are charging, and this costs time and money. So this is another disadvantage. Next price strategy is promotional pricing. Promotional pricing is when a product is sold at a very low price for a short period of the time. Advantage of this kind of strategy is it is useful for getting rid of unwanted stock that will not sell. Like you have ever seen the end of year sales, for example summer clothes are sold on lower prices at the end of the summer, and winter clothes are sold at lower prices at the end of the winter because the business want to get rid of their unwanted stock. So this is the promotional pricing. Another advantage is it can help to renew interest of the customers in a business if sales are falling. So this is another advantage. Disadvantages of this kind of strategy is the sales revenue will be lower because the price of each item will be low. So this is the disadvantage. Next price strategy is discriminating pricing. A business may be in a position to charge different prices to different groups of the consumers for the same product. For example, mobile phone companies charge high rates for phone calls at certain times of the day. So this type of this strategy is called discriminating pricing. So the product is same, but the price is different at different time of the day or at different time of the year. For example, the winter clothes are very expensive when the winter is in full flow, but at the beginning or at the end similar clothes are available at reduced prices. So this kind of the strategy is called discriminating pricing. Next is contribution pricing. This method taken into account that different products within our company might need to be priced using different criteria. For each product, a price is set in relation to the direct cost of producing that product and any contribution that the business wants that product to make towards covering its indirect costs and towards profit. So this is another kind of the strategy in which a business is producing more than one products, and business set pricing according to the importance of the products, and the business want some kind of particular contribution from different products. So this kind of the strategy is applied in those businesses. Next is customer value pricing. This involves charging the price that consumers are prepared to pay. Products which have prestige names attached to them, such as Rolex, may be able to command a higher price because of the status of these names. Products for the one-off events such as musical festivals or sports finals may be given a high price because they are unique. So this kind of the pricing is called customer value pricing. Next is psychological pricing. Many businesses seek to take account of the psychological effect of their prices upon consumers. This is known as psychological pricing. A common example is the use of the prices just a lower than a round figure, such as $199.99 rather than $200, or $29.99 rather than $30. So this kind of the strategies you oftenly see in market. So this kind of the strategy is called psychological pricing. Next is close bid pricing. This method of the pricing occurs when firms have to tender a bid for work which they are going to carry out. This is common practice for firms dealing with the government or local authorities. For example, if a new road is to be built, firms will be invited to put in a bid to win a contract for the work. So they bid. So this kind of the strategy is called close bid pricing. Tender, a bid to secure a contract for the work. This is called tender. Okay, now students, we are going to solve a question that is a kind of the question that frequently come in the paper from this topic. So concentrate yourself. What pricing strategy would most probably be used for the following products? Explain your choice in each case. First is a watch that is very similar to those watches sold in the shop. So the strategy in this kind of case may be probably competitive pricing, as the watch is very similar to its competitors. So you have to follow the price which your competitors are offering. You cannot charge high or low. So this kind of the case follow competitive pricing usually. Next case is a new type of the radio has been developed and it is a lot higher quality than existing radios. So this is a unique case. So probably price skimming to earn high profits to recoup some of the research and development cost. So you can charge high because your product is not available in the market. You are the only one who is selling. Next case is a chocolate bar which has been on the market for several years and new brands are being brought out which are competing with it. So the strategy for this kind of the case may be probably promotional pricing to increase interest in the chocolate bar. So you may offer lesser price for a short period of the time. So this is one case. Possibly competitive pricing. So because market is available in the market for several months, so competitive pricing is another common strategy which can be used for it. Next case is a shop which sells foods wants to get its money back on buying the stock and make an extra 75% as well. So probably cost plus pricing to ensure that it covers its cost and makes the target profit of 75%. So markup on the cost. So cost plus pricing is the method for this kind of the case. Next is a new brand of the soap powder is launched. There are already many similar brands available. So many similar brands are available. So you have to, may probably use penetration pricing. So less price for a short period of time as there are already similar brands available and they will need to get the new brand established in the market. So this is the case, or you may use competitive pricing as well. The next question is, what factors should a company take into account when determining its selling price? So factors might include product image. So what your product image is, this is the first factor that will affect your pricing. Competitors pricing, cost of the production, the stage of the product's life cycle, entry into the new market. So these are the factors which affect the pricing strategy. And the final question for the lecture is, often shops reduce their prices at certain times of the year. Why do they do this? So seasonal demand, cash flow problems, to stimulate spending at slack times of the year. So these are the reasons due to which some businesses lower their prices at certain years of the time. So this was the lecture, students, the pricing strategies. Read this lecture again very carefully. This is one of the very important topic in the business studies, and make your notes. Thank you so much.